Hello, my name is Bradley Smith, and I'll be doing a financial analysis for Dr. John Cresson's Finance 381 class. What I will be doing is I'll be taking a look at lows, and I'll look at a multitude of different ratios and compare them to determine whether or not I would loan lows a short-term loan, a long-term loan, or if I would invest 50% into their company. So when talking about a short-term loan, we're going to look at the cash, current, and quick ratio. The cash being the most liquid out of the three is cash over current liabilities. So they don't do they do not have hardly any cash on hand and they're not able to cover their current liabilities. We want this number to be high, so as a loaner, as a lender, all from 2010 to 2015, all those numbers are less than 1. So this is an immediate red flag for me. So I would not invest in lows. Although the current ratio is the ability to pay back short-term creditors, if it's above 1, they do meet this across the board with the exception of 2012. So, and I can tell by the quick ratio that Lowe's is the type of company that has long-term liabilities, not necessarily short-term. So when looking at a short-term loan, I would not loan Lowe's $1 million for 6 months. Next, we're going to look at the equity multiplier and the times interest earned. The equity multiplier is basically just financial leverage. It's the use of borrowed money to increase production volume and sales and earnings. Basically, the greater amount of debt, the greater the financial leverage. So, as an investor, as a lender, from 2011 to 2012, their leverage increased slightly, thus the times interest earned decreased. So the times interest earned is important to me if I'm giving them a 5-year loan, because the times interest earned basically tells me their ability to fulfill its interest obligations. So I want this ratio to be high. I want this number to be high. Now they do have good numbers, but from 2011 and 2012, the risk increased slightly, thus the times interest earned decreased. From 2012 and 2013, it was the same case. Even though in 2014 and 2015, although the leverage continued to increase, and their times interest earned began to rise again, as a lender of 5 years, I want that times interest earned to be really, really high. And Lowe's just doesn't cut it. So I would not give Lowe's a 5-year loan. Next, we're going to take a look at profit margin, total asset turnover. We already talked about equity multiplier, so we're going to look at return on equity and return on assets, as well as price to earnings ratio. So profit margin is net income over sales. Being that I'm invested 50% into this company, I want this number to be really high. And Lowe's across the board, it's very low. So that's not necessarily appealing to me. Next, we're going to look at the total asset turnover. The total asset turnover indicates the efficiency with which the firm uses its assets to generate sales. So they do have relatively good numbers. It's fairly consistent across the board. Now, as an investor, I'm definitely drawn to the return on equity. As you can see, from 2010 to 2011, 2012, constantly increase. With the exception of 2011 to 2012, this still looks good to me as an investor. So, now another really important ratio is the price to earnings ratio, which is the market price per share of common stock over the earnings per share. So a high price earnings ratio, basically it tells us that the firm has significant growth opportunities. So, the higher the price earnings ratio, the greater the investor confidence. This number continues to grow with the exception of 2013. So I want this number to be really high. I do. And Lowe's, with the exception of 2013, has a high price to earnings ratio, in addition to a good return on equity. But the profit margin is really low. So I'm kind of skeptical in this regard. I would not invest 50% of the company just for the simple fact that they're not generating a lot of profit. Thank you.